We've all seen the cycle, right? The news headlines turn absolutely blood red, the financial talking heads on TV start looking visibly panicked, and your carefully constructed portfolio begins leaking value like a punctured tire. And when this happens, almost every financial guru on the internet steps up to the microphone with the exact same piece of advice. They tell you to treat the recession like a Black Friday sale. Just buy the dip. But what if following that advice is actually the most dangerous move you can possibly make? Welcome to This Explainer. Today, we're breaking down a fascinating paradox about surviving a market crash, and it all starts with challenging the absolute most popular mantra in finance. Think about it. For the intermediate investor, someone who's actually spent years building up a solid nest egg, this whole concept of buying the dip is often an incredibly dangerous trap. It's basically a strategy built on a house of cards. Why? Because it assumes you have infinite liquidity and an infinite time horizon. It completely ignores the harsh, boots-on-the-ground realities of human survival during a true liquidity crisis. When a 40% market drop is actively threatening your family's security, casually throwing more of your hard-earned money into a falling market isn't a strategy. It's gambling. Okay, let's dive into this. Section 1, the liquidity moat. To truly protect yourself, we have to completely shift our mindset away from chasing ticker symbols. Instead, we need to focus on building what's called a defensive cash flow architecture. You see, the greatest investors in history, they don't frantically look for stocks when the economy tanks. They look for stability. They think like a fortress. You have to fundamentally change your objective based on the economic environment you're in. In a bull market, sure, you're playing offense. You're hunting for growth. You're looking for that alpha. But when a recession hits, your primary objective must abruptly pivot to survival. Most people get this totally wrong because they operate purely on emotion. They either panic sell at the absolute bottom or they try to average down out of sheer desperation. Both of those are emotional traps that completely ignore the structural reality of your personal finances. So before you invest literally one more dollar into a brokerage account, you need to establish a strict mathematical foundation. This is your liquidity moat, and it's calculated by your burn-to-savings ratio. It's simple, but man, is it ruthless. You just take your monthly essential costs, we're talking the absolute bare minimum you need to keep the lights on and food on the table, and you divide that by your liquid cash reserves. This calculation gives you your financial runway. And this brilliantly illustrates the magic number here, which is 12. 12 months. Listen, if your financial runway is less than 12 months, you are not an investor right now. You are merely a speculator in a highly volatile, high-risk environment. The market can stay completely irrational far longer than you can stay solvent. If you're forced to sell off your quality assets at the absolute bottom just because you suddenly need to pay rent, well, your buy-the-dip strategy hasn't just failed, it has effectively destroyed your wealth. This leads us to a massive paradigm shift. In a stable inflationary economy, you constantly hear people say cash is trash, right? But in a recession, liquidity becomes its own distinct asset class. Cash actually transforms into a strategic weapon. It becomes the ultimate ammunition you need to swoop in and buy quality assets when everyone else, from retail investors all the way up to over-leveraged hedge funds, is being forced to liquidate. Which brings us to Section 2, stopping the financial bleed. To properly build up that cash ammunition, you've got to treat your personal balance sheet with the ruthless, calculating eye of a CEO navigating a massive corporate downturn. Surviving businesses don't just sit around crossing their fingers, hoping for new revenue to magically appear. No, they aggressively prioritize stopping the financial bleed. For you, this means hunting down your hidden liabilities. These are those sneaky expenses quietly eroding your monthly cash flow and actively shortening that financial runway we just talked about. We're talking about those automated subscriptions to streaming services you literally haven't opened in a year, high-interest debt payments that just drain your liquidity, and frequent convenience costs that you pay for ease rather than actual necessity. So the crucial point is this powerful concept: aggressive cost-cutting creates guaranteed returns. Think about it. When you eliminate a hidden liability, you aren't just saving a few bucks. You are functionally generating tax-free income. You're redirecting cash directly into your liquidity moat, actively fortifying your defenses without taking on a single ounce of market risk. It's a total game changer. Now, the ultimate goal of all this aggressive cost cutting is to reach what is called the floor of security. This is that magical, stress-free point where your baseline cost of living is so low that a secondary income, or your cash reserves, can easily support you even if you were to lose your primary job. And ironically, reaching this highly defensive floor actually increases your investment risk tolerance down the line. Why? Because you're no longer making financial decisions from a place of panic and desperation. Let's look at Section 3, the safe asset myth. Now, what's really interesting about this slide is how it completely dismantles everything we've ever been taught about surviving a financial crisis. For decades, the traditional advice has been to run for the hills. Buy gold, buy bonds, hide in defensive sectors when the sky is falling. But look at what actually happens. When true widespread panic sets in, stocks, bonds, and gold all drop significantly at the exact same time. This is a phenomenon known in finance as correlations go to one. When over-leveraged investors are hit with massive margin calls, they are forced to sell absolutely anything that isn't nailed down just to raise cash. In the true crisis, all those historical market correlations just collapse. Your supposed safe havens plummet right alongside the broader stock market. You see, the fatal flaw of traditional safe havens, like, say, a physical gold bar, is that it literally just sits there. Sure, it might hold its value over the long run, but it certainly doesn't pay your rent, and it doesn't generate any immediate uncorrelated cash flow. True safety doesn't come from an inanimate commodity. It comes from assets that generate value completely regardless of what the stock market is doing on any given Tuesday. That means investing in personal skills, certifications, or resilient side hustles that provide you with immense stability and cash liquidity no matter how bad the broader economy gets.
Moving right along to Section 4, the offensive weight.
Let's move to and see how this builds. Once your personal balance sheet is locked down and your moat is filled, you enter the climax of the defensive strategy. Now, the offensive weight is not a passive state. It is a period of hypervigilance where you deliberately, consciously avoid chasing assets and refuse to play the market's chaotic game. Patience here is actually a highly strategic offensive stance. Step 1, you prepare your liquidity. Step 2, you aggressively lower your expenses to stretch that runway as far as it'll go. And step 3, you wait. You sit calmly on the sidelines while everyone else is scrambling, and you wait for one very specific trigger. That trigger is the capitulation point. This is the exact, precise target the defensive investor is hunting for. It is the moment when the last remaining optimists just throw their hands up in the air and walk away in disgust. The news cycle will be at its absolute most terrifying, and forced selling will hit its absolute peak. When everyone else is terrified and liquidating their portfolios just to survive the week, that is when you are finally ready to deploy your dry powder into incredible, high-quality assets at prices we haven't seen in years. Ultimately, recessions act as a kind of necessary, if brutal, cleaning cycle for the economy. They mercilessly punish the overleveraged and the unprepared, while massive generational rewards are handed over to those who properly maintained their liquidity moat. By focusing on defense first, you don't just survive the downturn, you strategically position yourself to practically own the ensuing recovery. It's literally the transfer of wealth from the impatient right into the hands of the prepared. So, as we wrap up this explainer, I want you to step away from the ticker symbols for a minute and take a really hard look at your own financial fortress. Stop trying to predict the exact bottom of the market and start extending your financial runway today. Because the truth is, the next crisis isn't a question of if, but when. And when the dust settles, the only question that will actually matter is this. When the last optimist finally gives up, will you be forced to sell or ready to buy?